Hi, Larry Gaines, PowerCycleTrading.com. This video I want to show you the correlation between the banks and the interest rates. It's pretty amazing, tight correlation. So this is the trade setup, and I'm going to walk you through why we selected the trade and how we set it up. So this is on Citibank. So first off, we were I've been looking at the rates. Everybody's been following the 10-year rate. And so we were starting to see that 10-year note start to push up. So looking at the bank correlation, XLF and et cetera, banks relative to the interest rates are tightly correlated with rates. So when rates go up, banks tend to go up. When rates go down, they go down. Now, the other thing with Citibank, we set this trade up last week on the 4th. So I'll walk you through it. But it also had a really nice, what we call volatility squeeze here. So if you look at this, it had this really tight consolidation pattern. It sold off really hard here, and then made a low down around the July the 20th. And this is also a 200-day moving average. So then it started churning, and we started to get a what we call a volatility squeeze right here, which is a sign of potential big breakout. Now we use momentum. Cycle 1 and 2 are momentum measurements, and that gives us probable direction. So we set this trade up right here. Now the other thing that confirmed and made the trade look like it's going to move higher was looking at the correlation between interest rates and banks. So let me show you the correlation there. So here, this top panel has got the financial ETF XLF, and then the bottom panel is the 10-year note index. So if you look just right here, this is on about January the 29th, 2021. You can see that the rates in the lower panel, interest rates started moving higher. Now look at the other panel. You'll see my pointer kind of going with it. So this was on the 29th on 10-year note, and so it started pushing up. And look at the top channel or panel, the XLF started moving up. Now it peaked out right here on the 2nd of June, and you see that the rates below this panel, rates started moving lower, and XLF started moving lower. And then on the 4th last week, we broke out of this channel on the 10-year note, the TNX index anyway, broke out, and XLF broke out. So the next thing then we went to is looking for a bank that had pretty low price that had potential to move, and we came up with Citibank. So top panel Citibank, same exact perfect correlation. So you can see here on the 28th, 29th of January, the below panels, the 10-year index or the Treasury index started moving up, interest rates up. What happened to Citi? Straight up, almost just exactly the same move. Then we topped out. We had the interest rates below bottom panel top out June the 1st. And look what Citi did, topped out and went straight down. And what happened last week on the 4th of August right here, we had a breakout of the channel here on the 10-year note index, and Citibank broke out to the upside as well. So the way that we played this in order to capture an upside move, but if it stalled, to get paid while we wait, we did what we call a call calendar diagonal. So here's the trade setup. So last week on August the 4th, we set this trade up looking for this potential breakout, and we were targeting, the first target was right in here to about 72. So we went out and we bought the 17th September 67.5 call, and then sold against it this week the 13th August 71.5 call. Okay, so really tight spread, but we did that for $315 per spread, and you can see today it went out over $140, about $143, $145 per spread, pretty much right into our profit zone there. So this was an alert trade. I have alert service, sent this trade out for that alert trade setup on the 4th, and then sent out profit take today to close trade out for over $140 or up about 45%. So we'll see if it continues on. What we can do next, if you wanted, you could have closed out and rolled the short strike further up and out, but we'll look to see if it pulls back. But that's one way to trade these types of trades, where you can kind of you don't have to be perfect on the as far as the timing, but it's just the direction, and this all lined up to have great potential direction to the upside based on what we call this volatility squeeze, the chart pattern, and that relationship or that really tight correlation of the 10-year Treasury notes versus the banks. So I hope you learned something here. I hope this was helpful. And to learn more about these types of trade, make sure to join us at PowerCycleTrading.com. Good luck trading.